You know what really sucks when you invest in dividend stocks? A dividend cut. So not only the dividend cut will make you lose income, but most of the time you will also lose capital. The best way to avoid dividend cut is to watch one single metric, and that metric is the payout ratio. Unfortunately, it is a lot more complicated than you think. Dividend growth investors, bonjour, my name is Mike Leroux and I'm the founder of Dividend Stocks Rock, and I'm also a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And to make sure that you enjoy your retirement, you want to make sure that your dividend is safe. And to make sure that your dividend is safe, you want to make sure that the payout ratio of each single stock you have is in order. But what's a good payout ratio? Is 100% payout ratio is safe? What is a negative payout ratio? How do you calculate it? Today, I'm going to answer all of those questions. So first, let's start with how do you calculate the payout ratio? So by definition, the payout ratio is really easy to understand and really easy to calculate. It's the dividend divided by the earnings per share. So quite easy. You pay $1 in dividend per share, you make $2 in earnings per share, your payout ratio is 50%. But then it's already getting a little bit more complicated. Do you calculate it quarterly, for the full year, or the past 4 quarters? So here's an example of how I translate in the real world. So I decided to take Royal Bank's payout ratio right before the pandemic. So you can see on October 2019, we had earnings per share of $2.18, a dividend of $1.05, the payout ratio for the quarter, 48.2%. Pretty solid. They're spending pretty much half of their profit, getting money back to shareholders. Everything looks good. January 2020, payout ratio 43.75, still in line, pretty solid payout ratio. April 2020, middle of the pandemic, first quarter where banks report higher provision for credit losses. You can see the earnings per share went from $2.40 down to a $1, and then boom, the payout ratio for that quarter only is 108%. Warning alert. For the full year, when you calculate the past 4 dividend payment divided by the past 4 earnings per share, you get a payout ratio of 54.76. So while for 1 quarter Royal Bank showed a payout ratio above 100, for the past 12 months, it was still pretty solid. So now, how's that 54% payout ratio compares to the rest of what happened with Royal Bank? So as you can see over the past 10 years, you can see that the dividend increased every single year besides the period of the pandemic because regulators prevented all Canadian banks from raising their dividend. For the earnings per share, you can see that on average it goes up all the time until it gets to the pandemic where it hurts. We see the earnings per share drop, and at the same time, kind of interesting, but if the earnings per share increase and the dividend per share increase pretty much at the same level, you can see that we get a stable dividend payout ratio until you get to the pandemic where now it gets to like those 45% all the way up to 54% for a short period of time, and after that what you see, earnings go up, the payout ratio goes down, and now we're back to something around 42%. So if you want to know if the payout ratio was high or not for Royal Bank at this point, it's better off to put that into a larger context. And numbers, it's always the same thing, such as statistics. If you don't put them into a context, they don't mean nothing. So 54% payout ratio, what it looked like back in the financial crisis of 2008, you see it on this graph where the payout ratio went above 72% back then. So the provision for credit losses were even higher. The company was in much distress and yet continued to increase its dividend. But 2020 was definitely not a good year. You can see it goes up rapidly. And if that payout ratio would have continued to go up, then it would have raised a big red flag. Again, if you put that into context right now, even if provision for credit losses has risen recently over the past few quarters in 2023 with a low payout ratio on like between 40 and 50%. The dividend paid by the bank is quite safe. Speaking of dividend being safe, what is a good payout ratio? Is it 40? Is it 60? Is it 20? Is it 90? Well, let's take a look at one of the oldest dividend king, 3M. So 3M on this graph starts back in 1990, and then you see that most of the time it goes around 50% from time to time. Since it's a cyclical business in the industrial sector, it could go up close to 80% and could go down to around 30% when things are going very well. So it gives you a perspective again that even with a very strong dividend grower with more than 50 years of consecutive dividend increase, the payout ratio will never stay the same, and it will go up and it will go down. In my opinion, a good trick would be anything above 20% but below 80% could be interesting. Why above 20%? Because you want the company to share a little bit more wealth with shareholders. Under that, sometimes the company may just forget about dividend, increase their dividend because it's definitely not part of their policy and things that they want to do to give back money to the shareholders. Doesn't mean it's a bad stock, but if you're looking for dividend growth, you want to have a payout ratio that is a little bit higher, so there's a little bit more commitment from management. On the other side, it doesn't mean that because you have a dividend payout ratio above 80% that you're at the wrong place. We're going to see that in a moment, but first let's finish with 3M. Even though the payout ratio is in order, if we look at the dividend triangle and we give a little bit more context, now we're starting to not having too much fun with 3M. As you can see, the revenues have hit a plateau and now they're declining. The earnings were slightly declining and then boom, it goes negative. That is a one-time event. Whenever you see that on a graph, you have to go inside a quarter and look at what is really happening, because obviously 3M is not going to lose money every single quarter going forward. That was linked to the legal suit settlement, so obviously it created a big out of money. It goes negative, but after that it's going to bounce back. What really worries me here is even though we have a solid payout ratio as we saw in the previous graph, we have declining revenues, and earnings per share are not growing, and most importantly, almost no dividend increases over the past 3 years. When I say almost no, is the company increased its dividend, but by a penny per year only. So we're talking about less than 3% increase in the past 3 years. That's not even enough to beat inflation. So definitely 3M is slowing down, and it's not a big surprise that when we look at the stock graph here, the stock price decline and it's having a rough time. We can see that all numbers point towards that direction, and now dividend is not unsafe, but you should definitely look at this one and monitor it quarter after quarter. Now back to the question, is a 100% plus dividend is safe? I know a lot of investors, they go into a stock screener and they say, you know what, maximum 80% or maximum 90%, but I don't want any stocks above 100%. Well, again, the number doesn't mean much if you don't put context. Look at this graph where we see Starbucks payout ratio at 296%. Chances are they're going to cut their dividend, right? Well, we have to go back in time. When that graph was reported in the middle of pandemic where a lot of their restaurants were closed. I mean, you cannot make sales and you can certainly not make profit if your business is closed. So obviously, payout ratio goes through the roof. What happened fast forward today? Well, as you can see, that was just a short moment in time and then the payout ratio went back to 60%. So when you look at a high payout ratio, don't start panicking right away. Look at the past previous quarters, look at the dividend triangle, and try to determine what is going on with the business. Maybe there's an explanation. As I mentioned earlier, with 3M, with the recent quarter showing negative earnings, we're going to see negative payout ratio going forward for a few quarters. Is it alarming? Not necessarily, but then it requires a little bit more monitoring. Moving on to another special case where the payout ratio is always above 100%, and I've done a few videos about this company. You can watch them in the link description below. Enbridge. So Enbridge payout ratio typically is above 100%, but the red line on this graph goes up all the time. How is this possible? Enbridge shows more than 25 consecutive years of dividend increase. I think it's 27 or 28 right now. It's like huge, big dividend grower, and yet the payout ratio is above 100% all that time. How could this be possible? Well, the solution in this time is not in the context, but rather in the calculation. The problem with a lot of businesses that are like pipeline, utilities, telecoms, they use a lot of capital to grow their business. We call them capital intensive. The problem with that is they have huge part of amortization hurting their earnings, but it's not really money, right? That's just accounting principles. So when you use the amortization, you're not really losing money, you're just paying less taxes because you're reducing your profit. So it doesn't mean that you do not have enough money. So what Enbridge does is they provide you with the calculation of distributable cash flow payout ratio. So the money available for distribution. As you can see here, we have the dividend of like roughly 89 cents. The earnings per share at 67 cents. That makes a payout ratio of 132. Oh my God, they're gonna cut their dividend. Wait a second. If you look at the calculation of the distributable cash flow per share, we get $1.37. So then the payout ratio is not 132 anymore. It's 64.74, so 65%. That is directly in line with what management targets to maintain a payout ratio between that 60 and 75% to have enough room to continue to invest in their business, maintain their pipelines, build new ones, and still increase their dividend. Obviously, those payout ratios are going to change a lot because Enbridge recently announced another acquisition that will close next year. We're talking about $19 billion in Canadian dollars, so it's not a small acquisition. They're telling us they're going to generate more distributable cash flow per share. We'll have to wait until we see it. In the meantime, for that specific part, we can see that the dividend is relatively safe based on the distributable cash flow payout ratio. Okay, so we have determined that calculating the payout ratio could change from methodology. So it could be quarterly, annually, or the past 4 quarters. We also learned that we need to add context to the number. So the number alone is nothing. You need to look at the history of the company to see what was the average payout ratio, see if it's above or under its average to determine if there's a problem. Another way to add context is to look into their quarterly earnings to make sure that you review and you understand a little bit more about the story behind the numbers. Finally, if you look at the dividend triangle, you will get the full context where you will be able to determine if a business that grows their sales, grows their earnings, and grows their dividend, technically the payout ratio will be pretty strong. So this is called a dividend triangle that is healthy. So those 3 parts, revenue, earnings per share, and dividend. Once you have this, the payout ratio should be in order. In specific cases, 100% payout ratio could still lead to a safe dividend. So I would definitely never use that in a stock screener, because then I would discard great companies for absolutely no reason just because I put an arbitrary number in it without having context. Finally, sometimes you're going to pull out numbers from a stock screener and you're going to get negative payout ratio. How could this be possible? What you see here for Verizon and BCE, it happened. They find a way to have a negative payout ratio. So how it's possible? So again, it goes back to the calculation. So for the cash payout ratio, we're going to look at the cash flow from operation minus the capital expenditure, so the money that you spend on projects, minus the preferred dividend paid. The important part here is if you have a capital intensive companies, like I told you, pipelines, utilities, telcos, any businesses that invest massive amount of money year after year to grow their business, that means they have huge capital expenditure. But in general, what the company will do is that it will also finance the capital expenditure with more debts, because it makes sense to use leverage to invest in a business, in a project that will generate future cash flow. In this case, we do not consider the financing option in the cash payout ratio. So it's just to see if the money generated by the company, so the cash flow from operation minus the capital expenditures and other dividend paid, is enough to pay for the dividend to shareholders. Obviously, in many cases, it's going to be negative because the cash flow from operation will be smaller than the capital expenditure. We would need to add the debt to have a clear payout ratio. Or you can look again into the financial statements and see, oh, okay, so Bell or Verizon took $3 billion in loans this year. In more loans, they have $2 billion in capital expenditure and $1 billion from cash flow. So actually they are making cash flow, enough cash flow to pay off the dividend, but you don't see it right away. Dividend growth investors, I hope that you have enjoyed this video and I hope that it sheds some light on the payout ratio. If you have more questions, please let me know in the comments below. I'll be more than happy to answer them or maybe do a follow-up video on it. Until the next one, that will be next Thursday, don't forget to stay invested.